Ladies and gentlemen.
Welcome to the BlockCrunch podcast, the go-to podcast for investors and builders in crypto. This episode is also brought to you by ParaSwap. Stick around to learn more. Hey everybody, welcome back to another episode of the BlockCrunch podcast. Now to kick off 2022, I wanted to do an episode where we kind of think about a framework about how to think about different things within crypto and how they're going to play out, maybe within next year, maybe beyond that. And I couldn't think of a better person to do this with than my friend Jason from Folius Ventures. And he's actually been in the crypto space for quite a while, and in my opinion, very criminally underfollowed. So make sure you follow Maple Leaf Capital on Twitter. So Jason, welcome to the show.
Well, thank you so much for having me. Like we are talking before we got started. It's a long time coming.
Yeah, I've been wanting to bring you on for 2 years now, and now that you launched your own fund, maybe you can tell us a little bit about how you got into the space and what is the thesis behind your fund, Folius Ventures.
Yeah, dog's bad, as I usually say. So I've been on Wall Street in the past 8 to 9 years. I was a Carnegie Mellon grad back in 2012. I did, investment bank, family office, and then my last job at a hedge fund. I was doing mostly emerging and frontier market small caps, where my specialty was SaaS software or anything that touches China. Well, I'm kind of glad I left because those two sectors that their intersection didn't really exist anymore in 2021 for a whole host of reasons. But I fell down a rabbit hole of crypto in early 18, and I thought that wouldn't that be a great idea to, really put my thoughts out there and have people criticize it. So I started Maple Leaf Cat, the Twitter account. Through that, I think during that time, not a lot of people were posting long form threads or even decks about the space. So through that, I met a lot of investors, founders, anons. Some of them became really good friends. And basically they managed to convince me as my conviction grew to come to the space full time. So I left that job in the hedge fund in May of this year, thanks to the support from ParaFi, from Dragonfly, from the guys at Framework, and many others. I was able to launch the fund in September, and it's been in operation for a couple months.
Yeah, and what I think is really interesting is that you're one of the very few funds that kind of straddle both East and West. I know a lot of funds claim to want to do that, but you're one of the few funds that actually moved out here and spent a lot of time with like Asia-based founders. So could you tell us a little bit about like the motivation behind that and what made you decide to drop everything in New York and kind of move out here?
Yeah. I thought, for APAC founders, especially Chinese ones, my impression then, and it's even more true today, is that, they can have access to 3 types of capital. If they are a grade A, Tencent, Alibaba guy, they can either try to get money from Chinese VCs, the Sequoia Chinas of the world. But those guys are, I wouldn't say they don't get it, they get it, but they move very slowly. And it's a lot harder to get them behind you when 90% of the portfolio has to touch with, mainland China and deal with Chinese government directly. As we all know, that's not the most friendly environment. So they tend to move very slowly or be extremely selective. The second group of capital is the sort of the Lightspeed, the A16Z, the Paradigms of the world. But I think they will be here in the next 1 to 2 years, but not today because they are, really busy with their portfolios and all sort of opportunities in the US and Europe. And the language, cultural, and a whole host of barriers sort of bar them from going full force into Asia. And the third group of capital they can seek is, capital from the likes of, say, Dragonfly and Spartan or SNZ 7X, where crypto native, been around for a while, really gets it. But that capital force at the moment is still small, relatively speaking. And there's a large group of, funds that made their money historically, in the older vintages through a completely different set of theses. Where I think if the founder is looking for somebody who's more thesis driven, who's more long term, who's more institutional, they used to not have a lot of good options. Increasingly, they have more and better options, such as your fund, Spartan. But I felt like there's a hole in the market, and I think raising dedicated capital to fulfill that purpose would give me an edge, and is also providing all those founders what they need.
Yeah, that makes a lot of sense, and I think back in the early days, I think a lot of the venture capital in crypto in China specifically were kind of Bitcoin whales, not a lot of institutional capital. So it's really interesting to see that change. And Jason, before we chatted, you prepared a bunch of predictions for 2022 and beyond for crypto, which we're going to get to that in a bit. But I'd love to clear something up as well, because a lot of people that I talk to, and I'm sure a lot of people you talk to too, have this impression that maybe like China-based projects are typically of a lower quality. There are a lot of scams, a lot of noise coming out from there. As
Yeah.
someone who's actually on the ground and who actually spends a lot of time exploring what's out there, can you kind of help us understand what's exactly happening in China and within the China founder community?
Yeah, um, I think the programmer class in China really came to be in the past, call it 15 years. I think it's a little later than the sort of 1990s, Bill Gates of the world when they were tinkering with computers. I think they were sort of, it really wasn't a big thing until '08 when mobile became a real thing. So that programmer class inherently is not only slightly smaller, although it's quickly rising, but also they still get treated incredibly well by the sort of the Alibabas, the Tencent, and the NetEases of the world, and really cushy job, way above average salary, really comfortable where they are, and they might not be as in a position to be as aggressive as the fangs in the West to really explore something
Mm,
like Web3 and crypto, especially when the Chinese government wasn't exactly friendly.
mm,
So there's a bit of adverse selection going on, which is if you are I guess, a senior, engineer, as opposed to Google, when that's the cool hot thing, you probably wouldn't leave. So when you have adverse selection, I think it's pretty natural to have like the impression of lower caliber founders, because it's those who can't make it, or those who are sort of really just in it to make a quick buck. Is the typical projects that people see. Um, but I think that's changing, and I think that's changing for the reason where a lot of these programmers are Western educated. They went to MIT. They took graduate school. They went to Google, and then they came back to China, hired well, for what they're specializing in. And I think a lot of what's happening is they see their friends in Google quitting and joining
mm,
OpenSea or something, and then that got those guys thinking. So I think and this is becoming more and more obvious this year, especially when the Chinese government is not only cracking down on crypto, but it's also cracking down on anything that's remotely rent seeking. I think a lot of these tech companies got absolutely smashed, and that got people thinking, "Oh God, like all my friends are jumping in. What should I be doing?" So especially in the second half, you see a lot of really high caliber talent really thinking about this, especially in the gaming space. And I used to joke that we're running a little over, but I used to joke that like the 0 to 1 moment happens in the West because it's a lot of the infrastructure, it's a lot of the cryptography. But I think Asia, especially Chinese, they're really good at B2C applications. They are good at being very aggressive and utilizing capital to gain market share and get a critical scale. So that group of founders, I think they're coming to the space. And whether they do it in Shanghai or Singapore, I think it's up to them.
yeah, and I always say that, the products with the most product market fit in crypto right now, the exchanges, right, the most revenues, they're all basically built by Chinese teams, at least
Yes.
most of them. And even the up and comers have moved here to Hong Kong, well, at least for a while.
Yes.
So I'm very interested to see that play out. And love to kind of jump into the predictions that you made, because there are a lot of super interesting ones here. And I'd love to start by diving into the first one, which is the highest level one. You mentioned that you think the ETH dominance level will go down as a consensus layer
Yeah.
as users bring their attention and wealth into many different chains. So can you explain kind of what you mean by that?
Yeah, I think ETH layer one itself chose a security trade-off that allows for heightened level of safety, but in exchange you have to pay $50 for one transaction. Um, I think in the past couple of years that's like fine when ETH price was a couple $100, but at $3,000 it becomes very expensive for most, if not all, applications, especially when you try to reach millions of people. And if Web3 tries to reach millions of people, I think the space is starting to take certain types of trade-offs, in terms of decentralization and security, in terms of can we jam certain data in different layers to, really save on block space, or simply, can we reach other types of consensus mechanism that is somewhat unproven in terms of security, but can get us a lot more throughput and become, hopefully more adaptive to the demand that some of the Web3 apps are having. As that happens, I think the original belief that this has to be extremely safe, extremely decentralized is I think as more and more people come to the space, and as the space become more and more B2C, the ultimate customers get to decide what they want. And I think until there's like a huge break event where decentralization and sort of security is really tested, I think people are just going to go where this experience is best and where they can still seek massive amount of P&L. And you already see meaningful amount of layer ones that get spun up, and all of them have their EVM sort of layer twos, if not already EVM compatible. Um, and all of them have a war chest akin to 100 million to $1 billion. So, and they're going to go really aggressive trying to grab an incremental, the next 10x of engineers building onto them. So as that kind of happens, as they spend that marketing engineering spend, it's hard to not envision when we get the next 10 million users, ETH will get the same sort of 80% plus market share to get a smart contract.
Yeah, I'm always super interested in this view about alternative layer ones because on one hand, I'm a huge proponent of building things that people can actually use, not just kind of crypto natives or crypto whales. But at the same time, I'm also a little bit concerned about the nihilism of having layer ones that are just scaling at all costs. And it doesn't matter if they're centralized or completely centralized. In the case of some kind of exchange chains. So kind of how do you think about the trade off?
I don't know. I still haven't come to a conclusion yet. I think at some point the state of those networks need to be snapshotted probably back to some consensus layer. It could very well be ETH. Um, but I sort of feel like there are a long tail of lower value use cases that are probably just fine, floating on these like less secure layer ones, as long as there is a clean and easy way to get back to the main chain. That's kind of my framework. But I don't. I'm still deciding whether this fragmentation will eventually migrate back to this like one or two chain being the dominant one eventually. I don't know what that would look like yet. But that's kind of a cop out answer. I think the sort of the quick and simple dirty trick is I really try not to pick that kind of layer one battle. I try to sort of pick the apps on top or anything that's like not layer one in the sort of infra and tools layer and bet on them instead. Because I don't think I really have an edge in which layer one's going to win.
That's really interesting because even in one of our first conversations, I remember you mentioning that your focus is mostly on the application layer and your edge is really there. So one of the app-focused predictions that you made is that it's possible that Uniswap and Compound and OpenSea will be forked by many top apps, and you get a lot of fairly destructionist token unlocks. So I'm really interested in what you think will happen because that's kind of already happened in DeFi before, with Uniswap being forked by Sushi Swap, and then Compound being I think forked by Cream, and OpenSea was recently forked by this I think Open DAO. So how do you think those would kind of play out?
Yeah, so it used to be I sort of there used to be only ETH and DeFi, right? If we remember, if we dial back to mid 2020, um, that's like there's only China before other civilizations. I guess if you're British, you would have thought the same thing. And then like all of the other industries starts emerging on all the other layer one. It's almost like new countries get developed. So like as the leading bank in England, like the Bank of England, yeah, they could set up branches in those other countries, but those other countries want their own stuff because boy, I want to be at the ground floor of the next Uniswap, and they're going to give me a lot more tokens when I use these, like these services. So why should I use Uniswap or Sushi? So one thing I was that wrong on. I mean, there's like execution issues also, but like SushiSwap's multi-chain expansion was like pretty vapid. Um, and to that extent, it sort of became clear to me that I think customer mindshare and owning the customer is just like in Web 2 is still pretty important. And whoever owns the customer's mindshare, whether it's on a new chain or just generally, is in an excellent position to rent seek, or just like be in a position to potentially have some take rate. You see it in MetaMask's 200 million annualized revenue. Um, and you also see in something like Axie Infinity, in their own Ronin chain, they have their own decks, and immediately, well, there's a farming reason, but they have massive revenue. So my sense is, if let's say I'm an application, right? I'm like an OnlyFans type app, and I was successful in grabbing all the cute girls. And all of a sudden I have 15 million users, and let's say I'm sitting on my own layer one, layer two that is on top of Ethereum. Um, I think what I want to probably do is to have, because if Uniswap V2 isn't that hard to fork. There are easy forks of Compound coming up. And if I want to fork a MIM like stablecoin, I probably can. OpenSea is going to take a lot more effort, but if I really want to, for my like interesting girl JPEGs, I can probably spend 3 months hiring some good engineers to specialize in something like this. And then what I get is I have 15 million of users on one hand that are always on my platform, clicking likes and subscribing. And on the other hand, they're like trading and transacting and interacting. And in my native app, like they probably won't go on Chrome and like download MetaMask and do all these other things if they're onboarded just through my native apps. And all of a sudden, I have this like massive, you know, um, financial empire infrastructure that I can just like grab because they are all pretty well built. And the take rate can go back within the ecosystem to support the currency, to further growth, to market. I think it's pretty natural, and I can tell you that like I think it's very natural for Axie Infinity to have their own compound on Ronin, and I think it's very natural to, well, they should probably use USDC because that's what everybody's used to, but they will probably have their own Axie open space, OpenSea, because then you have like the best filtering, you have like really in-depth in-game analytics that is tied to it, and I think the users would be most used to playing with it there, because like going to OpenSea is switching the network and then going 1 to 2 more hops. So that's kind of where I'm coming from.
So you're thinking that you're basically saying that any applications with current users can fork the tech of any other project, and that I guess the code itself is never really a moat. I
Well,
guess.
I guess not everything, right? Because the composability of these LP tokens, and to be able to be plugged in a huge liquidity pool to like borrow, is hugely advantageous. Um, I think there is a small subset of really major protocols in DeFi are just very natural tick rate generators for some of these major apps, and they are simple enough that they could just be grabbed like easily. The more complex sort of DeFi protocols, such as DYDX, such as Ribbon, such as your, I don't think it makes much sense for an application to grab them. Um, I think ultimately it's like, where do you want to take rate to reside question, and do I really need the composability that is currently existing in ETH?
Then does it make sense to keep investing in, I guess, primitive layer applications like the lending protocols or the trading protocols if the thesis is that any application with significant users can easily fork these and then just completely steal over the users? Or should your attention be spent maybe at the aggregator level?
Um, I think for me, I have really shied away from placing bets in the sort of easy copies. You can kind of, I mean, you see a lot of them, right? Um, I'm not saying they can't make money, but I think the bar for their success, um, I think, would be based on their own ecosystems. Is your Harmony chain going to do massive, massive volume in the future? And you, as the leading DEX with 50% traffic plus 80% attention, will be a clear winner. Um, but I think the application, it's a much harder game to play. Um, but I think owning the customer is where it's at.
And I guess with that note, how do you think about moats in DeFi? Right, we've talked about this a lot before on different mediums as well. I think some people think that the team is the moat, right? But to me, that's almost like a cop out answer because the team is always the moat in any type of company. Right? The team needs to be secured. So, what do you think is something that can actually give projects a defensive moat over time? Something that's strategic, that's very hard to just fork or steal.
I think it goes back to the good old, I think there are a few things. I think the mental model I use, it goes back to the TardFi days, unfortunately, but it's like, customer acquisition cost spent. It's like, oh, I know OpenSea, and that's the first one I go to. Like, oh, I want to interact with Web3. What does everybody use MetaMask? Okay, it's like everywhere, easy. And that's like a cost that was pre-spent, and customers just, it's the most convenient, lazy way to get to it. The second thing is the good old network effect, although I think there are strong forms and there are weak forms for OpenSea in particular. Like I'm actually pretty bearish on, if anything, that's like a JPEG platform on Ethereum wanted to fork OpenSea. I think it will be really hard to bet on all of them because it's a form of highly fragmented, single vertical network effect based business, because the searching cost and the transactional cost is so high to get the deal done. So you want the sort of platform with the most traffic. I think that's still universally applicable, except for liquidity in something like Uniswap is much more easy to migrate versus something like, let's say, on OpenSea. But network effects certainly would stand. And the third thing I would almost argue is like, corporate governance and ethics. I'm almost certain that a project with better ethics and just sort of like perceived better corporate governance and more transparency, pound for pound versus another project, would just get a better valuation. And the better valuation allows that protocol to attract hopefully better talent, but also have a better sort of bigger war chest to just compete. I think those three things right now is what I sort of perceive as the more important thing. That is sort of almost lastable moat.
Now, before I continue, I'd love to share one of my favorite products in crypto with you. Now, whenever I want to trade a token, instead of going to Uniswap, SushiSwap, Bancor one by one to see where I can find the best quote, I just go to ParaSwap to scan for the best price anywhere. Because ParaSwap aggregates all the popular Ethereum dexes and saves me a ton of time and headache in finding where I can trade something for the best price, and lets me trade in one place. Now, the cool thing is they've also integrated with Ledger Live as well, meaning I can now swap at the best prices directly from my Ledger wallet. So seriously, if you're a DeFi trader and you're worried about the security risks of centralized exchanges, but you also don't want to scour dozens of dexes just to find the best price, you have to check out ParaSwap. So head on over to paraswap.io/blockcrunch. And are there projects out there today that look like they should be easily forkable and not really defensible, but have done these few things right? These customer acquisition cost spend, ethics, and corp governance, that they have done it right and they've kind of managed to be market leaders so far?
Yeah, that's a good question. I think the UIDX have a bit of that, right? If you look on, and it has the fourth thing, which is like it's a pretty complex. Well, there are two kinks to it. The one kink is nobody can tell you what a token actually does, which kind of goes against corporate governance. But you know for sure they won't rug you. They won't just like walk away. And the second thing is it does have pretty solid tech that also makes it a very good experience. But I would consider them ethical. I would consider the liquidity and the sort of market makers that operate on that platform to be somewhat sticky, because you do want to operate on a platform that's like has a lot of traffic, and they sort of have that. And when you think about trading perp futures on Ethereum, if you really try to, that's like the first name that pop up, at least for people within the space. So for now, I think it's in a pretty decent position. Not that it can't face competition, but that one stands out to your question. I'm sure there are others, but like I haven't prepped for that question, so that's the only answer I have.
That makes sense. And I think it's also a good time to segue into the tangent that you mentioned, which is projects that own the customer relationship monetizes the best. So are there any examples that you have in mind about how projects are owning the customer relationship, and what does that mean? Like for founders listening out there, how do they go about owning the relationship?
Yeah, I always go back to MetaMask. It's kind of like, I think there are a few interesting misses by MetaMask. The multi-chain experience isn't the best. They miss an opportunity to become the inbox of Web3. It's crazy to me that you can't send messages in MetaMask, for example, because everybody uses it. 80%, 90% market share. I want to talk to Jason. Why can I? And I kind of know his address. He docs himself to me. Like, why can't I send a message to him? It should be an inbox. The experience integration with hardware wallet is atrocious. And overall, the UI UX is just not the best. Like, it could be iterated 10 times better easily. But what does it have is that it was built as the first solution to interact with, Web3 protocols. And it just became like, hey, just get MetaMask and interact. And then And then that's where I think that is the highest frequency application that every customer use every day. Um, like you it is you look at it every day, you interact with it every day. So the first thing you think about interacting with Web3, you think of it. And then because of that convenience, because of that sort of, you know, scale, they could try to monetize you in all different ways, similar to how Facebook and WeChat and all these other applications monetizes. And that's a powerful thing, evident by 75 bips take rate. Now, to be fair, part of it could be just farming for MetaMask tokens that is to come. But I bet you there are tons of people out there that didn't know like MetaMask charges 75 bips and they just swap because it's convenient.
Mm. And I guess in terms of the aggregators out there, right? So for things like 1inch or Wi-Fi or YEarn, these projects basically have a similar thesis where they want to be the one-stop shop where everybody goes to do for 1inch the trading, and for YEarn their yield farming, and then they want to kind of upsell their users by offering other services. What are your opinions on kind of those two projects or those two types of projects? Just
Hmm.
tokenized aggregators.
Yeah, I think they still need a channel to reach the ultimate customer because there are still customer acquisition costs for them. It's like how do users find them? And the users don't find them unless they look for them and when they become Web3 degen native, right? You have to kind of like dig a few layers deeper to really discover Wi-Fi. You know, it's not immediately obvious when you go and, you know, download MetaMask, like, oh, I need to like, you know, put some dollars to work and yield farm. Like Wi-Fi doesn't really immediately come to mind. And then the question becomes, what can Wi-Fi do to make that happen? Could it be, you know, like working very closely with MetaMask? You know, could it be working closely with Brave and the Chrome browser? You know, I don't know, and maybe maybe paying a rebate to become the de facto, you know, entryway. But it's not immediately like they will become the layer that aggregates everything below. Because for whatever that's below Wi-Fi, let's say if they do this well, it's going to be really, 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 really tough. But I don't know. I don't think they're at that stage yet where they just really become the thing that customer interfaces with.
Interesting, because when you said that you're looking at projects that own customer relationship, I kind of assumed that you were talking about aggregators, but it sounds like you're mostly thinking about MetaMask. Are there kind of other examples out in, I
Yeah,
guess, the public infrastructure space?
yeah. I think another one could be like say Coin 98 in Vietnam.
Mm,
Again, it's like a wallet like thing. I think Ledger and Trezor could be customer owning, you know, vehicles. I think it's if they have ambition, right, and if they can actually nail this, I mean, they could have a MetaMask fork. It's the most natural thing, right? 2 million users for Ledger, like they could at least compete. Um, I think all the games are excellent customer ownership tools, right? Because it's the first thing you onboard, it's the first thing you recognize. I think if Axie Infinity, well, they already have a Ronin wallet, but that's the app that people use. Um, and through the Axie Infinity Ronin thing, you know, people get to understand what Web3 is all about. So that's another user customer ownership tool. I think things that people spend a ton of time on could be it. So the bank from China, Zapper. Um, you know, I just want to see how my portfolio is doing if I'm in Web3. Yeah, I use MetaMask login, but like I will always have the bank open maybe just to like claim my farms or whatnot. And I really high frequency interactions. And I don't know how to monetize it yet. Maybe they have to think about it. But I think it's those kind of things that I'll be most interested.
that's super interesting because I personally have always been a little bit skeptical of wallets, with some expectations and with some exceptions, and also dashboards also with some exceptions there, because I always considered them to be quite easy to fork. But then in the past year, my experience of using things like Zapper or Apeboard, once I start using it, it's very hard for me to start another page and just inject all the addresses that I use. So there's actually some stickiness there. And an
Yeah.
example you brought up that I rarely hear that any other guest brought up before is Coin 98. So for people not familiar with what it is, can you explain what it is and kind of why you're excited about it?
Um, so Fan Lei, the founder, needs to get me some updated data, but it's basically the largest customer on ramp in Vietnam and maybe Southeast Asia. They are a comprehensive suite of desktop plug-in mobile phone app where it sort of amalgamates the purpose of MetaMask, Zapper, and even like WooTrade and Binance all into one application. So chances are, if you're in Vietnam and you're trying to maybe you get access to like Ronin first because you're playing Axie. But if you're like trying to do DeFi stuff, odds are you probably interacted with Core98 because that's where you get your information. That's where that is your plugin versus MetaMask. So it's like a full comprehensive user onboarding toolset. So I would say.
Interesting. So DYDX, C98, DBank, and Zapper. So it sounds like you're very much DeFi focused. I really like that.
Yeah, that's a part of the portfolio.
Awesome. And I guess speaking of DeFi, another thesis that you had is you think there will be a potential breakthrough of new DeFi primitives, and you specifically mentioned insurance and under-collateralized lending. So what gives you the conviction that this thing might take off? Because I think these two are the verticals that really lagged the rest of DeFi.
Yeah, and by the way, like I think conviction is a strong word. I think I would like down myself because I think they are interesting enough because it's unsolved problem space. And all of these market caps of these protocols are like not very good. And it's different reasons. I think for insurance, for instance, the typical holding period for the apes is probably anywhere between 8 to 72 hours. The cost of capital in the space, depending on who you are, ranges from between 6% to 45%. And it will be really hard. And by the way, this is an unknown question. You either have a bug in your code or you don't. And the best hackers are hacking versus trying to protect. And the cost of protection is really high and many different vectors. So you sort of don't really have a area with product market fit for direct B2C insurance protocol that takes the space's capital as its source of funding for a whole host of reasons. I'm intrigued in it because I also think audit today in the space is fundamentally broken. 2 to 3 month lead time, uncertain result. The best auditors might not catch the bug. Potential misalignment of incentives. I think it's not the first time you hear the auditor that audited code rugs the protocol. I'll tell you. I think there is tremendous room now that we see the breakthroughs of, let's say, Ohm and a few other things, to have for example, I'm giving you some alpha. If you're building this, after hearing me say this, you're building this, let me know. I think there's room for a all-in-one audit plus insurance DAO model, where you can call it insurance DAO, where you have hackers coming together doing B2B insurance for protocols in exchange for either cash upfront or tokens, and all while having your own token in the market as a listed company that continuously issue your tokens in an Ohm fashion to continuous buttress the treasury. And not only for audit, but you also offer protection of TVL through your treasury. So it's almost like a mini Berkshire in a way. And why would anybody buy into the token is because they will probably get the best deals in the market. I mean, who wouldn't want Paradigm working for you and auditing your code and providing insurance? Whoever builds that protocol and have the buy-in and have the legitimacy, I think would be a very powerful force. And that, I think, is what I would call a breakthrough. It's like a B2B kind of insurance like this. You probably want to talk about it later, but let me finish the uncollateralized lending first. The second part is, I think everything lending in the space today, so far, the majority is continuous priced collateral. It is collateral-based lending with a continuous price subject to liquidation. However, I think the space is migrating beyond from ETH and DeFi to multi-chain, multi-layer, multi-industry, where we start to see businesses that actually have real cash flow that is hopefully non-speculative. It can be levered and somewhat stable. Prop shops, nodes, miners, staking pools, increasingly guilds, DAOs, and I'm sure there will be other kind of organizations that can generate decent returns. And they will have leverage needs, they will have working capital needs, they will have ultimately credit demand. And I think a year ago, we don't have credit demand. It's like a soft space, maybe prop shops need it. But increasingly, we have this emergence of demand for credit that there's no way they will be satisfied by JP Morgan. They will be satisfied to some extent by BlockFi and Genesis. But I think it's even more interesting if they can be satisfied by, you know, Web3 native capital through some clever mechanism that allow for off-chain recourse, that allows for pooling of risk, and that allows for centralized or decentralized underwriting. I think someone needs to satisfy it. And the most interesting thing is that we'll have this token permissioned thing where, yeah, historically, like you're a debt holder, you get interest, but now you can have convertible bonds where, yeah, you get an interest, that maybe you get tokens, and maybe you'll get some really cool perks that were otherwise not available. So it's this emergence of credit makes me pretty bullish on someone potentially solving that problem.
And have you come across any projects that's launched that's doing either of these things right now?
Um, I think for insurance, not yet. Um, I think there are models that could follow it that could be interesting. I think it's very natural, for example, for Wonderland, for Ohm, for New Order, and the likes of these DAOs to start doing it. Um, but I haven't seen white hat hackers coming together. Maybe Sam one day will run something like this, and I would just probably ape in. So insurance, no. On lending side, I'm not sure what the best model is yet. I like the delegated model by Maple. Um, I think attracting capital longer term for them would be kind of an issue. So they have to do a lot of business development to attract outside of Web3 capital and really give them some perk. Right now, it's their own token. Eventually, they will need to figure out some other way. I think it could be a shoeboxed B2B solution that is a KYC AML token with some enforcement capacity, a servicer that maybe Violet is building. But it's like an amorphous space that's coming together at the moment.
Since you mentioned this idea of an insurance DAO, I think this is also a good segue to another prediction you made, which I was really interested in, which is that some investment DAO really kills it as the preeminent capital allocator. And this was probably the one I was most skeptical about because I guess in most DAOs, we still see some sort of a free rider problem, especially when they scale. You see kind of people undercutting their own DAO. So I'm assuming that with an investment DAO, if it really takes off, there's probably less incentive for people to really contribute and more incentive for people to front run the DAO almost in investment, similar for the insurance DAO, right? So if one individual contributor finds out a big bug, maybe there's more incentive for them to exploit the bug versus contribute to the DAO. So I'm curious how you think about specifically this free rider problem. And I guess in general, what gives you conviction that some investment DAO would kind of actually work out?
Yeah, that's good. That's a good point. I think I'll share some personal opinions first, which is I guess the first thing, the free rider problem is the cause of the issue is token distribution initially, and that they want to make it an Athenian democracy. I don't know why people think that DAO needs to be an Athenian democracy. I don't know why that share classes weren't experimented with vote segmentation. I don't know why the sort of modern corporate structure of token holders deciding council, deciding the management, and management having full control hasn't been experimented yet. I mean, this is a war of attrition and a war of scaling and a war of billion-dollar market cap we're talking about. So you kind of want a Caesar and dictatorship with it. I don't know why people have this like crazy notion that it has to be decentralized. It can be run like a company with 4 people, which a lot of them kind of are, except nobody wants to admit it. So the free rider problem to me seems like an issue of how you want to structure a token distribution and how you want your token holders to contribute. Because if there's no Athenian democracy, if the token holders are limited to their rights, and if there is a pre-built consensus that it's really the management that you're relying on, and you're actually trusting them to make all the decisions, I think these DAOs can move a lot quicker. So I think it's almost an org structure issue. Like, for example, like, if you and I were to start a fund and we launch this on chain and we have all the control, dual share class, 2 shares of B shares, 100 times the vote, and then a bunch of A shares for all the other, public LPs, and we have complete control. Everybody knows where we are. We set up the LLC in real life, tether that LLC to this DAO. I think it's perfectly fine. We're 2 dictators running this organization. Who cares? It's fine. So to that end, I think those experimentations will happen. And it's kind of already happening when you see all these guilds coming, because I really view these guilds as hedge funds. They are asset and gaming niche hedge funds that happens to have a loss leading arm of having scholars and sharing profits with these scholars to really win deals into the best and most lucrative early stage startups. And that's a beautiful, perfect model. You have hedge funds like Blackpool, that is literally just aping into quant NFT trading. That's perfectly fine. It's DAO. And Julian is sort of owning everything. I mean, it's really a multi-sig of a bunch of his friends, but that's totally fine. And what's the third one I was going to say? Paragon's DAO. It's literally a bunch of guys coming together, pulling their assets that is dedicated to the parallel ecosystem. It is a hedge fund, but that's totally fine because who doesn't want to buy a basket of all the alpha generators in this space, especially when Paradigm and the company is involved, right? And Yun Capital is involved. So, and you see these new models emerging, like New Order. It's basically a VC listed DAO. I mean, they're literally outlier guys sourcing deals, incubating them, and jamming their advisor allocation into the listed company, quote unquote, that is in the treasury. So I'm actually very bullish on personal human domain expertise. The space has gotten so complex that nobody can cover everything. A small group of individuals that is incentive aligned and know each other well and have the trust of the community can literally spin up these kind of organization DAO vehicles to gather assets and do what they do best, which is generating alpha in their own niche, and maybe get paid for it. And I think those guys are going to emerge. Like if 3DAO Capital, launches a DAO tomorrow, pulling capital on like influencer-based advisory token for their treasury, I would totally ape into that. Who wouldn't?
That makes a lot of sense. And I wouldn't be surprised if some of the larger names, like some of the companies that started back in 2018, 2017, started to become DAOs. Like I wouldn't be surprised to see a Delphi DAO or a DeFi Alliance DAO. Right?
Ape. Gotta ape.
Yeah, exactly. We're going to ape into all of these. Well, I'm super glad we got to discuss most of your predictions, but there are a few that we left out. But for the purpose of time, I'd love to kind of understand how you plan to spend your time or allocate your time in this coming year. Like, what are the areas that you're going to spend your most time in? Maybe some areas that you spend less time in.
Yeah. I've identified 4 areas that I think are most interesting. I think it's what I would call digital entertainment. Which includes games, but a bunch of other random social stuff that is directly to C. Second thing is what I would call new financial primitives, which we kind of talked about insurance but there's a bunch of other things that is not mentioned, like aggregation, like middleware, like a bunch of other stuff. I would say, organizations as a form of, quote, fund-to-fund allocation is very interesting. We kind of touched on that. And then a fourth one, owning the customer relationship, the Web3 entryway, which we also touched. So like everything we covered today sort of touched on what I would be most interesting, because I think this is the year where I feel like the infrastructure just gets good enough. The fiat on-off ramp just gets smooth enough. And the DeFi infrastructure just get robust enough where we can have some really crazy experimentations with smart engineers building like actual 2C and 2B applications that can bring us 10 million users. So whoever does that first will have a lot of power. What I would probably spend less time on. And the last thing, spend more time on. Hopefully I'll have people, and myself included, in these like alternative, interesting, burgeoning L1s and L2s, especially in things like Luna and Cosmos, and also Solana. And there are a few really interesting like new things happening on L. It's like I'm spread super thin. So I guess what I would probably do less of is like, I don't know, like if you're just copying and forking something that's existing, or you're sort of, I don't know, just incremental improvements, I'll probably spend less and less time doing it. And I don't know why that is, but a lot of engineers I've talked to who are excellent at what they do in Fang and finance, they come to the space and they're like, I want to do a Uni V3 sort of pool. Oh, I want to do like a yield aggregator. I'm like, dude, like you're really wasting your talent on something that's like only incremental improvement that you're very used to in Fang, but like I think you should think bigger. I really agree.
I think on that note, it's a great note to kind of wrap this up on. And for people who want to reach out to you and follow your insights, what is the best channel for them to do this?
Yes, you can follow me at Maple Leaf Cap on Twitter, same handle on Telegram. And you can reach out to me also through Jason at Folius Ventures.
Awesome. Well, thanks so much for taking the time, Jason. This is really fun.
Yeah, it's great. We should do this more often.
Definitely.